if you're available.
I am. Thank you. Good evening, directors. Hopefully everyone can see on their screen the Finance Committee report presentation that I will be going over. This is the report for the 8 months ended February 29th, 2020. So this is the report that we normally would have done at the Finance Committee meeting last month. So we're doing a little bit of catch up, and then at next month's meeting, we would be presenting the report for the 10 months ended April. Before I got started on my presentation, however, I think that Chief Harms would like to say a few things, so I will turn it over to him.
Thank you, Amanda. Good evening, directors, and thank you for the opportunity to talk here just a little bit. Amanda will go through the last 8 months, and I think if you look at the biggest change really that has happened has been within the budget, has been the last 75 days. You will see a lot of our assumptions and where we're at are pretty much online of where we expected them to be. But over the last 75 days really has been the biggest changes. Looking at those, our labor and services and supplies, those expenses have been less than expected. On the labor side of it and with the labor force, what we've seen is a significant decrease in really overtime. And that has a direct relationship to the cancellation of vacation, the staffing levels that we have out there. And so as we move forward, it will probably be somewhere between $1 million, $1.2 million. Just looking at the next report that we bring to you. Services and supplies is the same thing, where we see a reduction in the amount of supplies that have been needed, the ability to receive them, the ability to order supplies. I was over at the logistics just this week, and things really are starting to open up. So where we have depleted supplies, we'll see those additional supplies. So while we see a definite increase in savings on the labor and the services and delivery or services and supplies, the opposite is happening. What we will talk more about a little bit later is about the revenue portions of it. I think that our property taxes will be pretty close to target as we move forward, but overall our revenue decrease has been about the ambulance transports, and we've had probably about a 22% decrease in the medical side of it. We have seen call volume come back up, but our medic revenue is down. So we'll continue to look at that and talk more about that as we move forward. Again, as we get to the end of this year, we're really going to be looking at those ability to look at the expenses that are down, but also our revenue that is down. And I think we'll probably have some type of a balance in there as we move forward. So Amanda, I'll turn it back over to you to give the first 8-month report here.
Okay, thank you. So the first thing that we're going to look at is our cash balance history. So this is the cash balance in all district funds. So just as a reminder, we're not just looking at the general fund here, and we are actually looking at the actual cash balance. So as of February 29th, 2020, you can see we had about $24.5 million cash in all funds. You can see for this 2-month period, obviously we saw an increase in January, and that is reflective of the actual deposit of the first installment of property taxes. As you know, those are due in December, and we generally, and we recognize the revenue then, but we generally actually receive the cash in January. So that's what you're seeing here. Consistent with the previous year, but you can see that our cash balance this year is higher than it was at the same point in time last year. Separate from district held funds, we do have the CERB fund, as you know, the OPEB trust fund. So that is not included in the chart that we were just looking at. And as you also know, these funds can only be used to pay for retiree medical expenses. As of February 29th, 2020, we had almost $47 million in the CERB fund, which was made up of contributions over the life of the fund of about $38 million and interest earnings of almost $9 million. I know it's important to put these numbers in context so that that balance in the CERB fund compares to an overall OPEB liability of about $200 million. So we're continuing to make progress on funding that liability, but still obviously have a substantial unfunded OPEB liability. So turning now to look at our revenues, and what we're doing on this chart is we're comparing the red line, which is our actual revenues for this fiscal year to date. And you can see we have about 29.6 million through February, to both the blue line, which is our budget, and the green line, which is the prior fiscal year. So you can see that we're really tracking right on line with our budget through February. Obviously, this is comparing to a mid-year budget that was reset, kind of as of the first half of the fiscal year. So we expect the first half of the fiscal year to be on budget, but you can see that that trend is holding true January and February as well. Overall, we're budgeting a little over $41 million of medic cost recovery revenues. I think, some of the drop-off that we've seen in transports that has occurred in March and April, we may not see all of even on the next report, because this report is showing us money that's actually been collected in the month, regardless of when the transport actually happened. And it's at the end of the fiscal year that we sort of true up based on the time period of activity. So there will be a little bit of a lag in when we see that, but this will be an interesting chart to watch as we move through the end of this year. Turning to look at our total revenues. So obviously, most of what we're looking at here is property tax revenues. And as I mentioned, we did receive that first installment of property taxes recognized in December. That's why you see the line jump up in December. Looking at that red line so far through the end of February, our fiscal year to date revenues are about 126.7 million. That compares to a budget for the year of about 224.4 million. And you can see that red line is really right on the blue line, tracking on budget. So next we'll shift gears and look at expenses. This chart is showing salaries and benefits expenses. So through February, 121.2 million compared to a fiscal year budget of about 184.2 million. That the red line, it's difficult to see, but if you're looking at the red line for actual, you can see, particularly for that February, we're a little bit below budget there, and I think we will see that continue into March and April and possibly through the end of the fiscal year. And that's kind of what Chief Harms was talking about in terms of seeing some savings in overtime relative to what we have budgeted. Looking at total expenditures, we're seeing a bit of the same thing. So actual expenditures of 149 million through February. For the year, we're budgeting for 225 million. And you can see, again, the red actual line really close to budget, but just trending a little bit below it, particularly on that February dot. So looking at revenues and expenditures so far through the fiscal year, through February, we have general fund reserves of 8.5 million, but usually when we're talking about our reserves and our reserve ratio, we're talking about what we expect to be the case at the end of the fiscal year. So we are projecting for general fund reserves based on our budget of ending the year at about $30 million, which is roughly 14% of net budgeted expenditures. So it's very close to the minimum goal of 15%. And, a lot of these things that we've been talking about in terms of how revenues are comparing to budget, how expenses are comparing to budget, to the extent that we have actual results that are different than the budget number for the fiscal year, that obviously will impact this number. So if if we end the year with expenditures lower than budget and revenues on budget, then we would expect to have a higher reserve balance, all things being equal. So that's the number projected based on budget. So in summary, overall our revenues are on track with the mid-year budget through February. Expenditures trending slightly lower than budget. We have a cash balance of 25 million, which is higher than the prior year level. And as I just mentioned, our reserves are budgeted to be 30 million or about 14% at the end of the fiscal year. And that concludes this presentation. I'm happy to take any questions.
Please, Gay, go ahead.
Oh, thank you. I didn't see my raise my hand icon here. Thank you, Mr. Chair. In a general, I have two kind of general type of questions. The more specific one, however, is these days, how long is our lag time before we receive the MEDIC revenue? You mentioned lag time a lot, and I'm curious as do we have a handle these last few months what that lag time is?
Yeah, so I mean, I think it varies based on who's paying the bill. I looked at sort of the average for 2019, and it was about, I think, a 45-day average from the time the bill went out to the time the bill was paid. But that's an average. So as an example, you know, here we are in May, and we are still collecting revenue from July transports. Not a lot, but you know, there can be a very long lag. In terms of how we recognize the revenues on a fiscal year basis, we tie it to when the transport occurred, and it's so long as we receive payment for a transport that occurred in that July to June window before the end of September, then we will consider that to be revenue that was earned in that fiscal year. So that's the true up that I was talking about. So we really don't know until October following the end of the fiscal year what the true revenue that we will be recognizing is.
Thank you for that. It makes me feel a little better. I thought you were going to tell me months, and instead you talked about it in days. So that's optimistic from my viewpoint. So thank you on that one. The second one in, well, I should ask you, well, big general picture, it seems like we've had and a very good thing, we've had a significant increase in our general fund reserves. As I recollect, we were back and forth between 10% and 12%, and now we've jumped to about 14, and that's great. Is there anything in particular or a few items in particular to which we can attribute this increase?
So, so if we look at kind of the recent year history, probably the largest contribution to reserves came last fiscal year. So fiscal year 18-19, where there was at the end of the year about $6 million added to reserves. So that effectively is accounting for the difference between the 12% and the 14%. That, you know, that was the largest addition to reserves that we had in recent years. That was also the year where we had the GEMT quality assurance fee program that kind of came into place towards the end of the fiscal year, and somewhat unexpectedly. So I think, you know, that contributed, along with just having some reductions in mostly our non-labor expenditures, some, you know, supply service and supply purchases that ended up not happening in the fiscal year. In some cases, you know, being deferred into this current fiscal year. But that primarily accounts for the difference between the 12% and the 14% is the addition to reserves as a result of 18-19 actuals. Okay,
no, that's for me, that's reassuring to hear, because what it means is that when we do experience what could be called one-time revenues, non-recurring revenues, that we pay attention to building our reserve fund with those monies. So thank you very much, Madam CFO. Thank you, Mr. Chair.
Thank you. Amanda, one other question. You mentioned in the presentation our unfunded liabilities. In your view, long-term, is there a potential for us to reach that point where we do not have unfunded liabilities?
Yes, so for both our pension and our OPEB, the way that the actuarial valuations, which determine what our required contributions are every year, the way that they're structured is basically to treat those unfunded liabilities like a mortgage payment. So we're paying them off every year, and they are, they're set up so that over the term of that, mortgage, if you will, that liability will be paid off. So in other words, if, from here until the end of that remaining term, which, let's say 20 years, and in the example of how CalPERS amortizes unfunded liabilities, if for the next 20 years, all of the assumptions were exactly realized, then we would have, no additions or subtractions to that unfunded liability, and everything would be paid off, is essentially how those get structured.
I see. So in your view, in a world somewhat more perfect than this, 20 years and we would be there.
More or less. I'm
Okay.
probably oversimplifying, but that's the idea.
Okay, something like 22, let's say 150 years from now. Okay. I appreciate that, Amanda. Thank you.
Sure.
Are there any other questions? All right, seeing no other questions, let's move to the recommendations for the preliminary budget. So Amanda, this is yours as well.
This is mine as well. So hopefully the presentation changed on everyone's screen. So you should now be seeing something that says preliminary budget. And I think with this one as well, before I get started, Chief Harms would like to say a few words, so I will turn it over to him.
It did change, and so we have that on our screen. Over the past couple of months, myself and the deputies, along with Amanda, have been preparing the preliminary budget to bring to all of you. A lot of input from the actual managers out there, but we spent a lot of time trying to really look at the current state that we're in, and then where are we going? And I think, really that is a little bit of the question that we really don't have a lot of answers, is what is this going to look like in the future for the district? What's the revenues going to look like? With our partners in the city, I know the city of Sacramento, they're looking at currently a 5% cut, which is, $4.5 to $6 million out of their budget right now. And that is primarily based off of their income, which is off of the sales tax income. For us, we're in a very different position. As you all know, 70% of our revenue comes from property tax. About 24% then is from the charges or for transports. And really, we know that an impact of today may take 18 to 24 months. And so going through this, what we really looked at as a preliminary budget is what things can we do to put us up in the best position for moving forward. Our priority as we put this one together, as you will see, or as you look to more detail, is really what I would call a service delivery budget. And what does that mean? It means that we really focused on the needs of the district on the street, and what do we need to be able to support that for being able to move forward. The one that you see in front of you starts on July 1st. We will start the year under budget by just over $2 million. And so to do that, we truly went through the budget, looked at our revenue or our expectations for revenues coming in. We took the pension contributions, OPEB contributions, insurance, a number of things that we don't have control on, added all those on the front end. The increase with the contract that will happen during this time. And then with those, we still backed out an additional $2 million to be able to be, again, under budget for being able to move forward. A little bit more, what does a service delivery budget look like? And I said we backed some things out of there, but we also wanted to be able to put some things in there that would be flexible down the road. In the past, we would put a flex medics in service. They really were not budgeted, but we would look at the call volume in the system, and we would add those flex medics in to be able to hit during the flu season or during a deployment time when we had less units. We talked earlier this year when we did the surge protection contract of adding 5 additional medics possibly back into the system. What you'll see in this budget, though, even with the cuts that we've made, is that we budgeted 1 year for the surge protection medics. We also have budgeted in there the additional medics that have in the contract that we will have with AMR that'll start in July. Again, the great thing about some of these things, even though there's some expense that comes along with them, is as we move forward down the road, there's ability to decrease that service delivery without affecting some of the other things that are out there. So I think that we did overall in a good position for really some of the unknown that we have and for setting us for moving forward. The other thing that we really looked at a lot at was our staffing and our staffing numbers. As you all know, on Friday, we'll graduate an academy of 18 folks. When we look at our staffing numbers, we will be just a few bodies over, so just a couple extra members in the system. That is pretty normal. We had planned to run an academy of 20 to 25 coming up in this fiscal year of 2021. Our decision, though, was to cut that academy out. And being able to look at a lot of just unknowns on retirements, how many people are leaving, but also being able to give us the flexibility for staffing. We will, look at our numbers through the year, but fiscal year 21-22 will be probably a larger academy. But for this year coming up, we will not run an academy. The other things that we prioritized in there, and we came to you over this is myself and the deputies, this is our 5th budget that we're working on. And one of the things that we talked a lot about was the capital items and being able to replace engines and ambulances and some of the service vehicles. We prioritize those, and again, the engines and the ambulance are the top priority that are in here. A lot of other items that would have normally been in here, we removed those items out of here to be able to put us in a position for moving forward. Those items are removed. We have to look at them later on on the road as far as the deferral, but being able to look at them and doing those things now, again, puts us in a position for the future there. So right now, with the information that we have, a lot of help from Amanda and her insight and some consultants that work with us, we have the preliminary budget. I think this is a good plan for us for being able to move forward. So Amanda, I'll turn it over to you now, and you can carry us through the overview of the preliminary budget then.
Okay, thank you. So a couple of things I wanted to say at the beginning. First, so the preliminary budget is being presented to Finance Committee this evening, really in advance of input to presentation to the board at the next board meeting on June 11th. So that's when the preliminary budget would be adopted. And I will obviously walk through the budget in the presentation this evening, but before I got into that, and just to sort of follow up on some of what Chief Harms was talking about, I really wanted to begin the presentation by highlighting some of the uncertainty that surrounds the COVID-19 situation and any potential financial impacts. And really, I mean, I think uncertainty is the best word right now. We don't know what is going to happen, but I think we're taking a cautious approach to the fiscal year 2021 budget because that uncertainty exists. So if we can just kind of start off looking at thinking about maybe grouping these potential financial impacts into 2 different groups. We have immediate ongoing, which are more certain. We have more information, more data about what's happening right now, but probably lower impact than what some of the longer term potential items could be. So we talked a little bit already about reduction in EMS transport activity. We have seen that, and we are estimating that there will be a loss in revenues associated with that. So for example, for March and April, that total is probably about $1.5 million in lost revenue associated with the reduction in transports. However, offsetting that, we have already received over $400,000 in provider relief funding from the federal government, and are expecting to receive additional relief funding that can be used to offset lost revenue. So to some extent that's mitigated. And I think the other thing there that we've already talked about is we have seen that activity starting to trend back up. So I think that this is probably in the more sort of temporary impact category. Definitely there will be an impact to 1920, but at this point we don't have information to suggest we should project a continued reduction into fiscal year 2021. The other thing that's happening, you know, right now and has been happening for the last several months is that we do have some additional expenses that we're incurring in response to the emergency. So PPE, operating the community care response units, our emergency operations center, those types of expenses that are related to the emergency. However, we also expect that those expenses will be eligible for FEMA public assistance reimbursement, as well as we've submitted an AFG grant for some of our PPE expenditures. So I think we're thinking of those as also being lower impact, shorter term, really impacting us this current year, 1920, but not at this point projecting impacts going forward. The other group of potential impacts I'm calling medium to longer term is where there is just a great deal of uncertainty, but we recognize that there's the potential for greater negative impact. So that would be to property taxes, and I'll talk a little bit more about that on the next couple of slides. Pension and OPEB liabilities and those, you know, associated payments, and a possible shift in our EMS payer mix. You know, I think we've all seen the headlines about the number of people filing unemployment claims, and you know, it's reasonable to expect that that's going to result in a shift from private insurance to Medicaid, Medi-Cal coverage. However, you know, we don't know to what extent that's going to happen. We also don't know what the response is going to be at the state and federal level and any supplemental funding impacts that may be made. So that's an unknown, you know, sort of another uncertain potential impact out there. So turning to look at property taxes. I think one of the things that we need to keep in mind, particularly when we're talking about the fiscal year 2021 budget, which we are tonight, is that property tax revenues lag market events by 12 to 18 months. So the tax revenues that we will receive next fiscal year in 2021 are based on values that are set as of January 1st, 2020. So in other words, before any market impact as a result of COVID-19. So based on information from both our property tax consultant and the county assessor, we're not expecting any impact to fiscal year 2021 property taxes. Looking forward to fiscal year 21-22, those taxes will be based on values as of January 1, 2021. So those values will be impacted by experience through the end of this calendar year. And you know, there is some information obviously to indicate that sales volume has been down over the last couple of months. So there's potential for moderate to severe impact if the volume of sales doesn't rebound later this year. But I think that's the unknown, that's the uncertainty, is what the rest of this year might bring. And obviously looking forward into future years, there's even more uncertainty. So at this point, we really don't have any information to indicate what the impact to fiscal year 21, 22, or future year taxes would be over the next several months, and certainly through the end of the calendar year. You know, some of that data will start to materialize, and obviously will give us more information to be able to estimate impacts, but at this point, we simply don't know. What we do know is, you know, what has happened in the past. So what this chart is showing us is just the property tax revenue history for the district, kind of going back to the period of time before the last recession, through the recession, and then up to the current year. And I think that this is useful because it does illustrate that lag that I was talking about. So if you look on this chart, for fiscal year 2007-8. So the recession officially began December 2007, and it officially ended June of 2009. And you can see, kind of looking at those, you know, yellow call out boxes, we didn't actually see a significant decline in property tax revenues until the recession had already officially ended. Now, obviously, there were lots of economic implications that kind of rippled for several years after the recession, but this shows that that lag that I was talking about. The other thing that it illustrates is that at least during the last recession, and there's no reason to think that what might come next would be this, but it does show that there were several years of declines, and it actually took 8 years before property tax revenues recovered to the pre-recession peak. So that happened in fiscal year 2016-17. And because property tax revenues are such a significant funding source for us, as Chief Harms mentioned, representing 70% of our total revenues, that decline, those percentage declines resulted in a lot of lost revenue. So over that 8-year period, if you kind of compare that pre-recession peak number of 129 million to what was actually received in each year and add up the difference, it was 100 million in lost revenue over that 8-year period. So that just sort of illustrates the timing impacts, the significance of property taxes, why this is obviously something we're going to be paying a lot of attention to as additional data does become available. But really at this point, we don't have information to say what fiscal year 21-22 or future years would look like. But we do have fairly good information to say we're not expecting an impact in this next budget that we're talking about tonight. So turning to talk a little bit about pension and OPEB liabilities and what potential impacts there could be. Again, there's also a lag here, and actually just to step back a little bit, and specifically the impact that we could see is if there are investment losses in the pension and OPEB funds, that obviously would create additional unfunded liability and will require additional contributions. So for CalPERS, our fiscal year 2021, so this budget that we're talking about this evening, contributions are based on their actuarial valuation as of June 30th, 2018. So you can see there's about a 2-year lag there. So when we're looking at this current year and what's happening right now in terms of their investment return, the fiscal year return for 19-20 will impact the contributions that we make starting in fiscal year 22-23. And for this current year, what they've reported so far is that their investment return for the fiscal year to date, ending March 31st, so the first 3 quarters of the fiscal year, was -4%. It doesn't mean they're going to end the year at -4%. But it does mean it's less likely that they would end the year at the 7% assumed return, and that as a result of potentially having a return below that 7% assumption, there could be a requirement for additional contributions. So we'll have some more information about that, obviously, at the end of this fiscal year, and we do know that that would not impact us until 2022-23. Our OPEB contributions are on sort of a similar timeline. We actually have a actuarial valuation that happens every other year. But again, we wouldn't expect events that are happening this year to impact us until 22-23. So these are all things that, that we're considering and we're thinking about in developing our approach to the fiscal year 2021 budget, but they are not things that directly impact the revenues and expenses in fiscal year 2021. This chart just kind of illustrates what the potential impacts of CalPERS investment returns that below that 7% assumption, what the impact could be on contributions. So the red line is showing us what our contributions would be if the 7% return was achieved in fiscal year 1920. And each of the other lines, kind of by varying degrees, shows what happens if that return is not achieved. So the green line is, what if it's 0%? The purple line is, it's a negative 5% return. The blue line is negative 15%, and the orange line is negative 25%. And negative 25% seems drastic and severe, and I think is probably not likely to happen, but just to, again, provide some context, the CalPERS return for fiscal year 2008-9 was negative 24%. And the year before that, it was negative 5%. So these are not unprecedented numbers. I think the point of this chart is basically for every 1% reduction from that 7% assumed, it results in a $1 million additional annual contribution for us. That's essentially roughly on average how that math works out. Now, and this would assume that in every other year besides 1920 that 7% return was achieved. And I think, you know, on average, that's the expectation. That's why that is set as the discount rate. And while those negative returns did occur in fiscal 7-8 and 8-9, the 10-year average return for CalPERS, which does include that negative 24%, was 5.7%. So, you know, that does show that over time these things do tend to average out, but they do also have the potential to result in significant impacts to annual contributions.
With that, Amanda, thank you for that. Are there other questions?
Mrs. Gay, sorry to be delayed there. Well, one, it's good my microphone was off so you didn't hear me hollering and yelling with some of these things, for good and for bad. But more importantly, in the big overall picture here, we need now to start looking at even building our reserves even more, or some sort of anticipation for these uncertainties. As some people said earlier, plan for the, you know, expect the, well, just plan for the worst thing and then hope that it's not that. So we need to really be super conservative for the next few years in terms of trying to meet that potential increase in PERS required contributions. Just a big general overall feeling and comment. Thank you.
Thank you for that, Gay. Are there any other questions or comments?
So if there aren't any other questions or comments, I can move on with the rest of the presentation, which will actually cover the 2021 budget.
Yes, please.
Okay, thank you. And I think that this kind of goes in line with that thought of, because there is this uncertainty, even though we're not expecting direct impacts to fiscal year 2021, it makes sense to have a cautious approach. So as Chief Harms alluded to at the beginning, we are budgeting for a $2 million general fund surplus in fiscal year 2021. So that would be in addition to reserves of $2 million based on the fiscal year 2021 budget. And the factors contributing to that are, we do expect increases in property tax revenues, right? So those values are based on January 1, 2020. We're expecting that's going to result in additional property tax revenues in the 2021 budget, also additional medic cost recovery revenues and deployment revenues as a result of this current year being an unusually low year. So all that's contributing to additional revenues. And as I mentioned, we're not at this point anticipating any direct COVID-19 impact to the 2021 revenues. We also do have labor cost increases that Chief Harms mentioned, driven largely by pension, OPEB, and medical contributions. So really the same trends that we've seen over the last several years continuing. At the end of the fiscal year, we're projecting a reserve ratio staying at 14%. So although we're adding $2 million to reserves, doesn't change the ratio because we're also adding to the denominator, those expenditures. But the big point that I want to make in the overview here is that this preliminary budget really serves as a starting point. So I just spent a lot of slides telling you there's a lot of uncertainty right now, and there is. And I think we have good reason to think that a lot of those things where there is uncertainty probably won't affect us in fiscal year 2021. But we also know that we'll get more information over time. So we're going to continue to monitor our revenues and expenditures, and as in every year, you know, as warranted, we will make adjustments at final budget and mid-year budget, or more frequently if necessary. This chart is showing us all of the funds and the proposed budget for all funds. I'm going to spend the rest of the presentation really focusing on the general fund, but you can see all of the funds here. I apologize, I'm not able to do the animation to draw your attention to particular things. Maybe you can see my cursor, but basically, yeah. Yes, okay. Yeah. We're projecting general fund revenues of $229 million, pretty much equal to general fund expenditures of $229 million. And then as we usually do, we have a transfer going out of the general fund of $7 million, and that's going over here into the capital facilities fund. And that essentially is being used to pay debt service for capital items, so vehicles, apparatus, other equipment that were purchased in prior years, and then additionally to fund capital purchases in the current year that aren't being financed. So that transfer is going out to the capital facilities fund, and then we have $9 million that's coming in from the IGT fund. So that's the net funding from our IGTs. So overall, when you look at revenues minus expenditures, minus transfers out plus transfers in, we have an overall $2 million budget surplus. There it is there. The other thing that I wanted to point out, just because I won't be talking about the other funds through the rest of this presentation, I did mention the capital facilities fund. So we have about $6 million of capital outlay there. I think Chief Harms talked about that a little bit as well. So that's you know, apparatus, vehicle equipment replacements happening. And then also the other significant capital item that we have budgeted is $7 million in the development impact fees fund, and that is for the construction of Station 68. So I wanted to mention those two items of note. But moving on to talk more specifically about the general fund. So property tax revenues, I mentioned, we're expecting about $7 million increase in property tax revenues. We have a total revenue projected increase of about $14 million, total expenditure increase of about $11 million. So overall, that gets us to our bottom line here of a $2 million surplus, but that's comparing to a $1 million deficit budgeted in the current year. So overall, about a $3 million improvement year over year in the bottom line. So looking a little bit back at history again. So when we talked earlier in the presentation, we were focusing on property tax revenues. So those are the same numbers that you see here in the dark blue. But some additional context there is to look at the light blue and all of the other revenues overlaid there. And you can see that that recovery, if we look back at the past recession, actually happened a lot quicker than the recovery in just property tax revenues. So I think that's interesting to note just in terms of context. But looking at the year-over-year change for 2021 compared to 1920, here you see the total revenue increase of about 14 million, and then our property tax revenue increase of about 7 million. Looking at the distribution of our general fund revenue, we've talked about this already. Property taxes at 165 million, about 70% of our total revenues. Obviously, the next largest is charges for services, the bulk of that, but not all of it, being our medic cost recovery, but that total category represents about 24% of our revenues. And then the next most significant item is the operating transfers in, which is our IGT revenue, about 9 million or about 4%. Looking at expenditures, again, no surprise here. Our labor costs, we're budgeting 194 million, which is 82.2% of budgeted expenditures. Services and supplies are 30.8 million, about 13%. And then smaller categories are assessments and debt service, a little less than 2%, and that the transfer out to the capital facilities fund at about 3%. So talking a little bit more specifically about the budgeted labor costs, so that $194 million labor budget is a $10 million increase compared to the current year budget. Some of the changes that we've already talked about are increases in required pension and OPEB contributions. I did want to mention here that that this OPEB contribution is the first one that's factored in a reduction in the discount rate or the assumed investment return on the OPEB side. As you know, we've talked a lot in recent years about how that's been factored in on the pension side. This is the first year for OPEB. As a result of that and some other assumptions, we did have a $2 million increase in our OPEB contribution for 2021 versus 1920. Also have actual increases in medical premiums that occurred midway through this current fiscal year, and then assumed increases that would be effective January 1, 21, contributing to increases. As I mentioned earlier, we are budgeting for an increase in deployment overtime. That's really because this year was unusually low, so that creates an increase in next year compared to this year. And then there's an assumed 2% wage increase effective January 1, 2021, based on the assumed increase in net taxable value. I do want to highlight that both of those are assumed because we don't know what the actual increase is. The assessor normally would finalize the tax roll by July 1st. However, we just received word today that there was an extension granted on that. So we won't know what that number is for several months. I think we're hopeful that we will know that by final budget, but at this point, it's just an assumption. And then the other change, as was already mentioned, is deferral of the next firefighter academy beyond this fiscal year budget. So there's a savings in 2021 versus 1920 because of that change. Looking at services and supplies, so total budget of about 31 million. That's about $1 million increase compared to, that says 1819, it should say 1920. And 1.3 million is for those additional contract ambulance units. We have about a $500,000 assumed increase for our liability and property insurance. And then offsetting those amounts is there's a $1 million decrease for safety equipment, clothing, and supplies due to the fact that we had a large one-time purchase in 1920 for the SCBAs, and also related to the fact that we're not planning an academy for fiscal year 2021. And then finally, we have about a $300,000 overall decrease due to reduced travel, conference, and training budget. And that was really part of kind of, sort of stripping down the budget, sort of addressing the uncertainty, and trying to be conservative and cautious in our approach to how money is being spent. Other items in the general fund. So that last category of debt service assessments and contributions, that totals $4 million. It includes assessments that we pay to the county for property taxes and to the state for the GEMT quality assurance fee. I already talked a little bit about transfers. So the net there is a positive $2 million. That $7 million is going out to the capital facilities fund and $9 million coming in from the IGT fund. So again, overall, total revenues minus expenditures plus transfers, we have a $2 million surplus, which would be a $2 million addition to reserves. So starting the year at $30 million, based on this current year budget, we would expect to end the year at $32 million, or roughly 14%. And that concludes my presentation, but I'm happy to take any questions.
Are there any questions? Then I do have one, but I think it would be for the chief.
Yes.
Chief Arms, looking at the decision not to run an academy for this year, what do we project as the ripple effect of that? What do you think it will mean for us next year, so on and so forth?
So two things that we looked at real close is the amount of retirements and where our staffing is today with this academy graduating on Friday. I feel very good that the staffing levels for us are in a good position. The real unknown thing is, and what we see in a lot of folks, is uncertainty on folks leaving and retiring. Mm-hmm. And while these past few years we've seen just 30 to 40 people a year retiring, we had already predicted that curve was starting to come down, and that we would really see one academy per year and then a couple of academies coming up where there was maybe one or two. As far as expenditures, if you'll usually at mid-year, we'll look at it. It used to be that the cost of a full-time employee was cheaper than paying overtime. Really what we've seen today is that the balance between the two of them is really close. That full-time employee plus overtime is pretty equal. What are the good sides of it? I think that allows us to manage our biggest expense, which is 82% of the budget is people. Bringing additional people on board right now during the difficult times would limit our decision making down the road. What's the bad side of it is that as additional people leave the district, there will be more demand on overtime for the membership that is currently here. So we'll have to watch that really closely and then really look at the next year's budget and the planning cycle. Within this year's budget, we removed the academy, but through the HR side of it, we continued the funding for the recruitment and the actual process of testing for positions and being able to bring people in. So we will continue towards the second half, so the first 2 quarters of 2021 for testing and preparing a list for people coming into the district for the academies in the next fiscal year.
Great, thank you. Are there any other questions?
Mr. Chair, this is just a point of information. When we finish this meeting, I have a question for Art. I just didn't want to take up meeting time. So Art, please stay on.
Seeing there are no other questions, then that concludes the agenda for this. Our next meeting of the Finance and Audit Committee is to be determined. Anticipation auction or presentation items is also to be determined. And with that, we're adjourned.